Japan's stock market, it's been one of the world's top performers, right? But lately, it's been sending out some seriously mixed signals. So today, we're going to figure out exactly what is going on. I mean, on one hand, you see it hitting multi-decade highs, which is incredible. But on the other hand, all this chatter about policy shifts and global risks has got everyone on edge. You look at all these conflicting signals, and it's just really hard to know what's actually happening. To cut through all that noise from the daily headlines, we're going to need a better framework. We need a way to just step back and see the entire landscape, not just, the individual trees. And that's where this powerful tool comes in. We're going to use what's called the four-layer analysis to get a much clearer picture of what's really driving the Japanese market.
Think of this as a way to organize all the chaos. Instead of trying to look at a million different things at once, we're going to systematically break the market down into four fundamental pillars that shape how investors feel and, more importantly, how they act.
So here's the big reveal right up front. The core finding is this. It's a total tug-of-war. The positive forces that are helping the market are in a dead heat with the negative forces holding it back. It's that simple. Okay, so let's break down each of these four forces. We've got market, policy, trade, and geopolitics one by one, and really see how they stack up against each other.
Now for each layer, we'll assign a score from 0 to 100. It's pretty simple. Anything over 50 is a positive tailwind pushing the market forward, and anything under 50 is a negative headwind holding it back. This will show us exactly what's helping and what's hurting.
All right, first up, the market layer itself. This one's a clear tailwind, scoring a really strong 62. Now that tells us the market's internal health is still pretty robust, even if it's cooled off a little from its absolute peaks. And here's where it gets really interesting. Look at this divergence in volatility. While the US VIX, the fear index, is on the rise, signaling nervousness over there, Japan's version is actually falling. This shows a relative sense of calm in the Japanese market, even as the rest of the world is getting jittery. But here's where things get complicated. The policy layer? That's a whole different story. The Bank of Japan is signaling a huge shift. They're becoming more hawkish, which basically means they're thinking about raising interest rates. And that's a massive change from their super easy money policies. And let me tell you, it's making investors very nervous. This slide just lays out that internal conflict perfectly. We're looking inside something called the Financial Conditions Index here. You can see on one side, rising interest rates are a big headwind. They're tightening things up. But at the exact same time, the weak yen and high stock prices are still providing support, acting as a tailwind. It's another tug of war right inside this one single layer. Okay, moving on. Let's look at the trade layer. This one comes in as another positive for the market, scoring a solid 56. And that is a great sign, mostly because of Japan's incredibly resilient export performance. Exports, especially for things like AI gear and auto parts, are growing really steadily. And what's crucial is that the global supply chains are running way more smoothly than they were. Plus, with the threat of major US tariffs fading for now, this layer is firmly in the market's corner. And finally, that brings us to the geopolitics layer, which scores a 46. This is our second headwind. It's just a persistent drag on sentiment, It reflects all that ongoing global instability, trade tensions, and energy security risks that are always kind of lurking in the background. Okay, so we've got two tailwinds and two headwinds. Let's bring all four of these forces together, get our final composite score, and see which side is actually winning this tug of war. And you can see that battle laid out in black and white right here. The strength from the market and trade layers, scoring 62 and 56, is being almost perfectly canceled out by the drag from the policy and geopolitical headwinds at 42 and 46. It's uncanny. So what does this all boil down to? A final score of just 51.5. And remember, 50 is dead neutral. So this shows us the market is basically balanced on a knife's edge. It's barely positive, but for all intents and purposes, it's stuck right in the middle between risk on and risk off. Now, this score doesn't just tell us where we are right now, it gives us a really powerful lens to look at what might happen next. Given how neutral that score is, the base case is probably that the market just keeps trading sideways, caught in this tug-of-war. But a clear shift in either that policy layer, like a surprisingly aggressive rate hike, or the geopolitics layer could easily tip the scales one way or the other. So what does this all mean for strategy? Well, this framework is pretty much screaming, don't make any huge bets one way or the other. Instead, it points to a balanced approach.
First, keep your overall risk in check, matching that slightly bullish 51.5 score. Second, balance your sectors. With that strong trade score, export-driven areas like IT and autos look good, and with the policy shift, financials could benefit from higher rates. And finally, maybe use any of those news-driven dips as potential opportunities to act.
And that leaves us with this central tension, doesn't it? The story of Japan's market right now is one of really bright spots and some pretty big, growing shadows. The internal strength is the light, while the policy shifts and global risks are those shadows. And the big question this framework leaves us with is, which one is going to define the market's next chapter?